All right, guys. So thank you so much for joining tonight. I really apologize for the technical difficulty there. It's my fault. But I'm super happy to have Stefan. He's living in New York. We've been speaking for, I don't know, a couple months now. And what he's doing in real estate is actually quite interesting. It's a little bit different than what I'm used to. He's very analytical, using more data. And I think what he's going to present tonight is going to be very, very, it's going to be very different, and it's going to bring us a different perspective to investing in real estate, especially with the data that he brings to the equation of investing in real estate. So the show's all yours.
Mm-hmm. Yeah, thanks, Matthew, for the nice introduction. So, all right, do you guys see my screen now? Yeah.
Yeah, perfect.
Okay, so like you mentioned, so I have a kind of like data-driven approach to real estate investing. So I'm founder of a company called Quant that brings data-driven and quantitative techniques to the real estate industry. I live in New York City. I previously had a career in finance, managing a large derivatives portfolio, and I studied financial engineering at Columbia University in New York City. And I'm an investor. I speak on analytics, like here tonight, and I've been on like different webinars, podcasts, events. So data-driven investing. It's a very interesting topic. It's very technical. So don't get like too, like maybe scared at places, because it's just kind of, it's good to get to see something new, I feel, and like an introduction sometimes to different people. So what's data-driven investing? So it's 6 different bullets, can say. So one is automated underwriting for called on-market listings data. And I know most investors, they would say on market, there's no deals there and so forth. But once you do it in a data-driven way, such as pulling like tons of data and like looking at the top 0.1% or something like that, then it could actually be meaningful. So sort of having like deals like underwritten end-to-end in an automated manner, programmatically via scripts and codes and so forth. One can hire like different like virtual assistants perhaps, or like different people to do it perhaps, with coding skills, meaning not virtual assistants per se. And so that is one like piece, like automated underwriting. So a second piece, so if we have off-market stuff, let's say in the commercial space, so modeling deals is extremely important. So I've been doing it like searching for commercial multifamily deals myself, where I would pull rental listings data and model this rental listings data to kind of try to approximate which are the properties that have bigger value add, and it's off market, very little about them. You don't have an actual income expense sheet for that property, but okay, you can model them, and approximate. So it's kind of an approximate version of automated underwriting. And then another thing on the market side, I feel like many people, they pick their markets. Okay, they say like, I'm going to invest in Atlanta, Georgia or somewhere, and I have like this job growth, population growth, look at like a few different numbers. But I feel they don't really know the whole picture of like every single market in the country. So, and they don't have this more rigorous code regression approach, or, more like analytical approach. So kind of like a more statistically valid approach on the market side, and including understanding downside risk. Besides and forecasting appreciation. So that is another data-driven component. And automated valuation models. So those are like very, like not everyone likes them, because with Zillow and Redfin and so forth not doing well with their their iBuyer businesses, for example. So that has been having some backlash there, so to say. But automated valuation models are useful as an investor when searching for deals to find price inefficiency, especially in illiquid markets. So, for example, I've been finding deals upstate New York that would have that are discounted, and like using a very basic, simple AVM is useful for that. So this is another like data-driven technique. And another, and that's like gets like perhaps very professional to more like larger firms that are looking for bigger deal flow. Having some sort of condition scoring is important, because otherwise you need to hire like acquisitions analysts to do your or you need to be like screening many deals manually. So having some sort of condition scoring on the textual and visual side, so that's kind of machine learning techniques, can be useful. And it's something that's been coming to the industry. And there's like some companies that do it. There's a company in New York called Foxy AI that they do computer vision for property condition scoring. So it's sort of like pulling photos of different properties and assigning like in what condition. Let's say 1 is a perfect condition, 5 is a not so good condition, and so forth. But those are like some data-driven techniques. And I would say like a bonus other one is, let's say, neighborhood appreciation predictors using social media signals. That's something that Lofty AI used to do. So before transitioning to more blockchain, like tokenization kind of model. So like where you would pull, let's say, what are, if there's going to be a cafe, or like, let's say if there's a change in the breed of dogs that people have in the neighborhood, and you detect that with different social media signals, and which of those variables have actually predictive of appreciation in other neighborhoods, and so forth. So this is another 7th component. So these are all pretty technical, but there are different ways like one can utilize various vendors, or perhaps like hire people to do them. And again, it's like just to give a perspective, like a slightly different perspective, and of some of what I've been doing myself in my own investment practice, and what is really out there. There are few people who do it. I mean, Neil Bawa is fairly known. I don't think he writes his own scripts. I'm not under this impression, but he's like very analytical on the market side for sure. He understands markets well. There are a few other friends of mine, people that I know who do like relatively data-driven approach. So it's not data-driven, I would say, well, manually underwriting deals. So it's necessary. It's very difficult to underwrite like physical asset like real estate, but manually underwriting deals, well, it's not data-driven. Failing to kind of perform analytics on top of off-market data, let's say just pulling Prospect Now, or BRD matrix, etc. feeds, but not really analyzing that data. Well, that in itself is not so data driven, and kind of picking, selecting, let's say, a few markets in real estate. And real estate is very local, obviously, and there are reasons to select just a few markets, also for like building your vertical integration and so on and so forth. But really picking like just several markets and not understanding the bigger picture and kind of back reasoning their strength, is in itself not data driven. Manually gauging property values, where in some instances like automated models could do a better job, is not as well. Or for example, if you pick a Marcus and Millichap report and you say, okay, it has a Kodo summary report. So are you going to internalize that information, process it, and understand it? Maybe no, right? Because you're going to have perfect summaries that themselves are derived data-driven, but you're not building intuition with the data. And so what I'm actually kind of like trying to illustrate here as well, kind of the benefit of the mindset of data-driven investing, really the benefit of building intuition with the data and understanding it a little bit more. And well, utilizing no risk management, no concept of market valuation, no downside risk predictors. To me, that is also not that driven. So like some different topics, I'm going to try to touch like a little bit briefly on them. So so these are like some topics for today. So starting with automated underwriting. So just an introduction. So it's and actually, Matthew, I just want to make sure to stop me, because it is kind of technical. So I want to make sure it's not going to be kind of like too much in this sense. I just want to show like a little bit of what's out there.
Oh, go ahead.
Yeah, sure. Yeah. So scripting or coding is always useful. So like in Python, like, most people are not going to do it themselves. But again, like you can hire people to do that. It's just like the concept again being is in Python, for example, rose in popularity in recent years. And there's like various also internet languages, like on the browser side, on the server side, and so on and so forth. So having a technical understanding of those things is an advantage in most businesses. It's an advantage in marketing, in fact. Yeah, it's one can do like very data, like analytical marketing systems using that. And I've done it in part for my webinar for Finance Meets Real Estate. on the marketing side. So it's a very useful knowledge. Now, web scraping or manipulating data over the internet has various legal considerations. So that is something that one needs to understand also better, perhaps work with an internet attorney, etc. I think so for residential properties, let's say that are not commercial, so that could be just done on market, straight off the MLS or realtor.com, Redfin, Zillow, places like that, and kind of performing, like computing all your cap rates and various returns and so forth. And there's like also different vendor APIs that can be used for some of that data. So those are Data Affinity, Tovo Data, or also like some web scraping companies and so forth. So in case you wanted to have it integrated within your business, so you could partner with those vendors, they could web scrape the data for you, or just deliver the data to you in a processable, easy to process manner, such as in CSV or Excel and so forth. And so then performing scripting to gather and analyze the data. So, using different functions. And, there are many challenges, like data fields could be non-homogeneous, like large data sets, like not sort of data outside of discrete fields, requiring text classification, like natural language processing and so forth. Condition scoring is another challenge, and multiple data sources, right? So it's a pretty challenging thing. But again, like hiring companies such as the above, such as Data Affinity, Tovo Data, etc., can very much help in some of that goal. And so what are the outcomes? Well, the outcomes are that you can now evaluate thousands of listings automatically end-to-end. Now, I've done this myself at my company. I've been investing around New York City. I've been pulling like around 6,000 predominantly small multifamily properties. And I've been doing it on the commercial side more recently as well, with pulling, even on market, which, with all the skepticism for that, or off market various commercial data, but it's really having thousands and thousands of listings that you have either modeled or underwritten in an automated manner, and sort of having a ranking across multiple strategies. So another benefit is you can, when you're manually screening for deals, you're just like narrowly focused on this single strategy. But if you do it in this more automated manner, now you can actually scale it more. You can get like 7 different strategies or 5 different strategies and so forth. And really the goal is to discover inefficiencies and sort of to professionally trade the US real estate market, like the way, let's say people trade in finance. And of course, it's not a liquid market, it's different, but using some of those techniques helps you raise liquidity a little bit and improve that. So condition scoring is an interesting technology topic, like that I mentioned, via machine learning. So condition scoring is a key element in roadbook to automated underwriting. So if you don't know the condition of properties, now you're not able to get like renovation estimates. You're not able to, just like analyze the deal so well. And so this is achieved via computer vision, natural language processing. These slides here, they're from a presentation I did for my webinar, where it went a little bit technical on, okay, what are some of the packages that you can use if you went on doing it yourself. But again, you can also hire various vendors or companies to do that. And so, but really the concept is, if you're able to condition score via computers, you would not need to hire perhaps acquisitions analysts, or maybe you'll still hire them, but a big chunk of the work will be done and you will be operating at a different scale. And so this is, so that's condition scoring. It's an important tool. There's different ways. There's an old school approach with regular expression. There's the newer, like natural language processing models for that. So different approaches to that. And on the images side, so there are different packages in Python, and there are different vendors again. So like I mentioned, it's not something that you need to be building yourself. You can actually get it. You can send a feed to Foxy AI, negotiate some pricing with them. They are going to return to you, okay, those are for 5,000 properties. We're going to screen their images, underwrite their conditions for you, and you don't have to screen those 5,000 properties yourself. And so that's like condition scoring. Commercial multifamily modeling. So that's something I've been getting into more and working on releasing it as a product under Realty Quant, actually. So the concept there is, okay, if you have like different markets in the US, how can you get from all that off-market inventory, what are the best buildings? And considering that they're off-market, considering you know very little about them. And so commercial multifamily off-market modeling, it's, well, so we know valuation is done on based on income approach in commercial multifamily. But again, how do you scale preliminary analysis for many buildings? And I did a kind of showcased an example for my webinar where I had like 32,000 commercial multifamilies data, and I was showing, okay, have them like ranked on some on the criterion of you know, what's the NOI improvement potential. So what an investor cares about, how much you can raise the value of those properties. So that's commercial multifamily modeling, and so the usual sources for data there are places like Reonomy, Artimetrics, Prospect Now. But they give you, let's say, they may give you like seller motivation kind of insights, or they may give you perhaps just the feeds of buildings in different geographies and what are their, let's say, what is their tax value, what is the owner information, then just kind of direct mail to them. And if you actually want to get intelligence on those buildings, how do you do that? And so one approach is to derive it based on rental listings data. So what's the biggest vendor of rental listings data for commercial multifamily? It's CoStarsApartments.com. So it's really, if you use rental listings data, you can get various insights into the income and expense sheets of commercial buildings. So that can be like, okay, what are their rent levels and unit mix compared to the immediate neighborhood, same property costs? What are their other income components, like pet fees, administrative fees, so and so on and so forth, approximate occupancy rates, what utilities are being charged to tenants. And so this gives you if you think about it, what is the goal of this modeling? It gives you preliminary glimpse into the income expense sheet of a property. And that's simply by looking at their rental listings data. And now you can actually model, okay, you can model many buildings on that very preliminary information, and you can approximate which are the ones that have more potential in improving their income expense and improving their net operating income, raising the value of the property. Now, to do that, you need to like go through different steps. You need to scrape the data, model the data, produce like summaries of it, and so forth. So it's really a technical approach, but in the end, what you have is you have a ranking of, let's say you are in Charlotte, North Carolina, and you have maybe 500 buildings, and there are 100 unit buildings, 200 unit buildings, 50 units, etc. And you kind of have a ranking of some of those properties, and you have it near the top, the ones that seem to show the biggest value potential. Now, somebody might say, okay, why do you care about knowing the best ones? I can just direct mail to all of them if they're either off market, right? Well, sure. Well, that's because on the market side, perhaps the approach is not so data driven. Now, if you take it differently, perhaps you could just direct mail to the top 20% in 5 different markets, or now that you assume you have a better understanding of the market side, and I'm going to get to that as well. So that's another approach. And so that's like just on the slides, it goes in more detail. Automated valuation models, so just like kind of on the educational side to mention, I mean, this is what some of the companies that are, well, in trouble right now, like Zillow, Opendoor, and etc. do, but it's used for various other purposes as well, also by Ownerly, CoreLogic, etc. It's used also in the appraiser industry, in the lending industry, and so forth. So it's really like being able to value, houses using algorithms, right? Now, it's a very challenging thing, no doubt about it. But if you operate in very liquid, and here I take the perspective of an investor. So if you operate in very liquid markets as an investor, and where really, like it's really, some prices could be significant off. So using a very basic automated valuation model can help you in your kind of arbitrage trading or discovering efficiency trading. And so there's like different approaches, like here again on those slides, I was going on some of the technical side, how you can do it yourself to build like a basic AVM. It's really, here's like several lines of code of a very basic AVM, actually, just like 5 lines or whatever. It's quite interesting just to see what something like Zillow's estimate really is. And so of course, then it gets like much more complicated as you build it deeper and deeper. And it's really one of the tricky parts there, is one of the important parts. If you think in real estate, location is extremely important. So having you have a numerized location, and you need kind of a machine learning model to account for that, because you can have like a you have a numerized location, then you have another numerized location right next to it, and that second numerized location as well is really kind of garbage, you know. It's like it's a really bad neighborhood, and the first one is a really good neighborhood, and so but they're like right next to each other, so it's not linear. So it's not like a linear thing, you know, once it's numerized. And so that's why you cannot do it like with like the older time methods. You need like more like machine learning methods, and that's what like all those Zero and so forth companies they do. And it's a basic technique there's called gradient boosting, a gradient boosting method, and so forth. Okay, so now like another perspective. So less, I would say less technical, but kind of more finance. So now you have to like, and I've been kind of like very active, speaking to different like syndicators, speaking to different people in the industry, kind of trying to, you know, like influence them that, okay, using valuation metrics or fundamental analysis in real estate is actually works. So you're not in the stock market where you have technology companies where it's harder to value and where you have also the earnings of those companies distorted. Now in real estate, you have income from governmental agencies like the Bureau of Economic Analysis, you have housing supply data in the US, and perhaps in Canada, perhaps available as well. I haven't looked so deeply into Canada myself, but really, yeah, having housing supply, population data as well. And so all those fundamentals, they're fairly, I don't want to say not manipulated, but at least perhaps less manipulated than earnings will be in the stock market. And also prices, it's not a technology sector, it's real estate. So it's actually fundamental analysis works. But this is the case from finance that was arguing fundamental analysis by John Hussman for kind of predicting, you know, potentially downside risk like in the stock market, and he was arguing for some metrics that are better than price earnings ratio in the stock market. So I kind of was a bit inspired by that. And so I did a study before the sort of for the global financial crisis, like a back study. And so these are like the declines that happened after the global financial crisis. And again, like just to kind of backtrack, what is the goal of this piece? It's really when you're picking markets as an investor, so you want to forecast appreciation. Now, that's relatively well, I can get to the appreciation, so it's relatively well done by picking like good population growth, income growth markets, approximately. It has imperfections, I can get to that. But how do you predict the downside risk? Well, the downside risk, nobody predicts, basically. Nobody's even dealing with it, for as far as I have seen. So one way to do it is, it's a backstudy of global financial crisis. The declines that happened, the biggest ones were in 4 states, California, Nevada, Arizona, and Florida. And so declines were in the, let's say 41 to 56% range. Now the same markets on deviation from their fundamentals, sort of, this is proxied by affordability deviations here, or price income ratios, which is an extremely simple approach that anyone can do. And that showed like 85% correlation. So valuation metrics, how much are prices deviated from their fundamentals? So they were in the same states of Arizona, Florida, Nevada, and California. They were very high numbers. Those are the ones that dropped a lot. If you look in the middle of this table, so there were states that were undervalued at the time, like North Dakota, South Dakota, you know, even Texas. So Texas was 5% undervalued at the time. And if you look at how much they dropped, well, they barely dropped. It's actually the average drop was 4%. 4% was also the average decline in income after the global financial crisis. So it's sort of normalized by income terms. One can say in valuation terms, they actually didn't drop many of those states. And that was quite a finding for me when I did this study that, okay, it's not like you have something in a global financial crisis, not like real estate crashes everywhere. It only crashes where it was overbought. And so that's quite interesting. And so very high correlation versus subsequent actual price drops. And so here I have to jump to, another presentation where I actually have the current numbers. And so, yes, so this is like, again, on the market side, and that's something that my company Realty Quant publishes this data for 2,700 US counties. That's one of the things we do amongst like some of the prior stuff that I mentioned. And so this like state level data. So this like current market valuation. So it's quite interesting. It's like there are 6 states to the west, namely Idaho, Utah, Arizona, Nevada, Colorado, and Washington that are above 20%. And then there are 2 states to the south, Texas and Florida, that are also above 20%. And that's very recent. Like most of these numbers more than doubled since the first quarter of 2021. So over the course of, less like few months, a few quarters, like less than 1 year, they actually more than doubled. So sort of the beginnings of like overvaluation or more significant overvaluation started in the second and third quarter of 2021, at least in the study that I do. And so before that, US real estate was broadly very fairly valued. And I'm sure you guys have heard about Canada being very overvalued. And that's actually a phenomenon in the so-called scans economies. So Sweden, Canada, Australia, Norway, and New Zealand, which are in all kind of like small open economies that are commodity exporters, where there was some that have independent central banks, where there was some cutting of interest rates during the, I guess like 2014, 2016 commodity crunch. And so that was since there are like some articles online. Perhaps you can Google for those scans economies where their real estate actually as early as 2018 was very overvalued. And it stayed overvalued. Doesn't mean it's going to correct, right, that it's overvalued. There's nothing that says to the timing of it. But now with some of the current spikes in interest rates, that could put some pressure potentially. But those are very overvalued. But US real estate in 2019, that's Bloomberg Economics. There were other sources like, I guess, Dallas Fed. There is a study at Florida Atlantic University. There are other different sources. And so it was actually fairly valued. So, and that continued through the first quarter of 2021, but it changed after. So it's quite interesting because there were like so many investors who were saying, okay, it's buy hard assets. It's good with inflation to buy hard assets. It's true kind of, but it has also a flip side that it renders those markets overvalued compared to fundamentals. And so incomes didn't actually increase all that much in Arizona and all those other markets. And so it kind of made them overvalued. So those are like some of the current valuations. They're not too high. It's nothing crazy. It's not like the global financial crisis, but again, coming from a fairly valued market, this is some overvaluation in Western and Southern markets. But again, if you go to the Northeast, many of those markets are even undervalued, like New Jersey and others, or Connecticut, of course, and so forth. But then, and then the Midwest, broadly speaking, fairly valued. So if you look across the US, it's really not, it's not so overvalued, but just there are a few markets. And then perhaps the only pronounced overvalued one is Idaho. And so, okay, yeah, so that's, and this is kind of what I was mentioning about. So many of those where if we take Texas and Florida, they were, market valuations are fairly consistent in normal times. So they were staying in this positive 7 to 10% range for about 4 years, 2017 to 2020. And then suddenly in the third quarter of 2021, those numbers were kind of doubled. And then they've been accelerating a little bit since then. So it's quite interesting to see like some of the effects of inflation, but now with higher mortgage rates, perhaps some of that will slow down. And it doesn't seem like it's particularly scary, but again, for people who are investing in Idaho or Arizona, there are some considerations to be made in terms of downside risk. And so, yes, so just one moment. So this is another like data-driven piece. And just to finish up the market side, so that is for downside risk. But in terms of if you want to forecast appreciation, I know I'm kind of going on many different topics, and you guys can just like ask questions at the end, or feel free to interrupt at any time as well. But yeah, if you want to forecast appreciation, so how would you do that? So how is it done in the current process? So you have a syndicator who is like pitching to you a deal, let's say, and they say, okay, this is a great market, it has this population growth, income growth, there is perhaps housing shortage, this job growth, rent growth, etc. But again, like it's often like price selecting kind of hot markets, if you will, and sort of back reasoning their fundamentals. Or in some cases, at least it is. And so one thing that it is, okay, how valid is this approach, that is being taken? So if we take the fundamentals and we inherently in our mind forecast them, because that's what we do, because we're really looking for appreciation. So we assume if that market is growing well in population, growing well in income, perhaps real estate prices are going to grow as well. Now, if I did an approach where, okay, I took the fundamentals, so I took income, population, housing supply, I forecasted them separately, and then I forecasted the real estate prices of that. And that gave a 5 times bigger error than if you just forecast the prices themselves. So that's quite interesting. So there are reasons for that. I'm not sure if I have it on the slides here, but one of the reasons is momentum, or it's autocorrelation in real estate. So real estate has very high momentum. If you're in Florida or something, there's like 80% momentum or autocorrelation. And then if you're in Alaska, there isn't any. It's actually was like slightly negative autocorrelation, but that's a pronounced exception. You're in Alaska, there's no momentum. It's like weird, right? But if you're in Florida or in Massachusetts or some of them, and then specifically even in like more primary markets in those states, it's actually pretty high momentum. And so forecasting price time series, interestingly enough, like stating like your investors, like all those different fundamentals, how they're good and so forth, looks good on paper, but it's actually not the best approach to forecast prices. There can be different reasons for that. Sometimes prices appreciate beyond the fundamentals. And if you're just tracking the prices, you're actually predicting it better. And so, yes, so that's kind of like the approach to forecasting that I use at my company, at Realty Quant. And so there are different techniques. ETS is one, exponential attribution, SARIMA, and then there is a model called Facebook Profit. And if the trend continues to be the same, like in 2018, 19, then you get a pretty small error in your forecasting. If the trend is different, like in 2021, then you get a bigger error. But again, this is just to show, okay, what is a more rigorous approach to picking markets on the appreciation side? We already touched on downside side, that's pretty much not practiced. Unfortunately, I've been trying to convince many people to start looking at that, so that you know, that's I think like very healthy for the market overall. But again, like on appreciation, so this kind of I feel the more rigorous approach. So really looking even at the history of appreciation is perhaps better than looking at population growth or something like that. It's very strange. It's actually becomes an easy answer, you know, like an even easier approach to picking market in a way.
Somebody's got a question for you.
Yeah, sure.
Vinti, go ahead.
Hey, Stefan, thanks so much for the presentation. Looking really good. Had a quick question about the momentum you were talking about. At your company, are you comfortable sharing the assumptions you're making when it comes to the metrics, to the basically the calculation you're doing, what assumptions you guys are making to understand what movement is?
To the sure, yeah, sure. So you mean in terms of the forecasting, right?
Correct. Yes. Correct. Yeah. So when you think about the forecasting, right, you're thinking about the future. So there's some assumptions we have to make. So I'm coming from a finance background, where in corporate finance, we typically predict in the futures, and we have to make some assumption based on historical factors, right? So from your perspective, can you rewind on how you did that, just to understand a little bit more?
Yeah, I mean, if you look at, okay, I think I found like this slide, for example, here. So, okay, so let me make it full screen. So, yeah, so if you look at, let's say here, if you're saying you're investing in Florida, so okay, and that's like, it's not like the specific market, just very high level at the state level, right? So you have Florida at 77% autocorrelation. So that's kind of the argument for momentum. But I don't really, honestly, I don't really make assumptions. I just try to test it out. So it's really like a study, like, like this one. Like I try to, I try to do my best to forecast stuff for myself, you know? So I try to, if I forecast income, population, and so forth, am I going to be able to predict the prices? No. So I get a pretty big error, 7%. So that's kind of currently what an investor does, right? Because you just pick, you're not going to be running statistical models, but you just inherently you do it like that, right? Because you're going to pick a market that has this population growth, has this income growth, has all those parameters. Correct. But it's harder to, so in doing so, inherently you commit a 5 times bigger error. So that's now on the downside risk. I can share more on that. So that's really, it's again, I wouldn't say an assumption.
No, that makes sense. That makes perfect sense, because I see where you're coming from. So you're using so your levers are basically the population growth, the factors you can point at and saying that's actually data. So you're pulling data from different, like different levers that we know, like population growth, income growth, rentability, and all these different conditions of like lifestyle. Like, for example, I'm in Austin, And what you were saying is making sense, because in Austin since 2015, the average home price increased adjusted to inflation is around 4%, which is what historical inflation is in the US. So I was very curious on how you were arriving at those numbers, but that makes perfect sense. Thank you.
Well, I mean, yes, but let's say you have Austin. So that's like a very good question, actually. Because I hear like often people say, I mean, honestly, forecasting, I'm not like, it's something I do just because, okay, let's have some kind of model, right? Let's not have nothing, it's not like it just works while the trend persists. I've never been like honestly personally so crazy about forecasting in this sense. I'm much bigger on something like fundamental analysis, like like the downside perspective. And if we take something like Austin, I often hear that people say, okay, it has those extremely booming elements there, that there's all these factors being built and all that different elements. And then it's often the argument is, and then I'm going to say in something like here, let me go to Austin just 1 second. I think I have, okay, so here, if you look up, so those are like market valuations in different cities. And so that's based on county level data. So the most overvalued city in America is Boise in Idaho. Okay, so that's not me. That's consistent among like 5 different sources. So that's for the Atlantic University, that's, what was it? It's not Bloomberg Economics. It's another like big, I can it's another like big vendor actually. And then there's like a third one. So it's Boise is like really, really up there. So and it's actually really the only place that is sharply overvalued, because the other ones are not that much. But then perhaps like number 2 among the bigger cities is actually Austin. And so then, so this fundamental analysis, right? Okay. Now, if people say, well, you're perhaps not accounting for many different factors. Yeah. That in Austin, there's this factor and that factor, all those things that are happening there, they're pretty crazy. And okay, and so they're like unique. But it's not like I'm, how to say, tracking a change of, this is not like a mean reversion model or something, simply where, okay, I'm just tracking a long-term trend, but now the trend is accurately higher. I'm looking at the real fundamentals. I'm looking at the income, I'm looking at the population in Austin, I'm looking at the housing supply. And so if somebody says, okay, there's all those amazing things, well, their population will reflect it, their income is going to reflect it. So if everything is so amazing, their incomes ought to move accordingly, and that sometimes happens. So for example, that would be, so Denver at the beginning of COVID. So Denver was top 5 price performance in the top 100 people. But Denver was actually at 0% in this kind of fundamental analysis. So Denver was fairly valued. And so if I was living in Denver and not like computing exact numbers, I would think, okay, Denver is like crazy overvalued, like prices have appreciated so much. But if you actually compute it, then you find out, okay, well, actually it's not, And so it's like, that's kind of like the situation. And again, like, how do you trust like something like this, like the numbers? Well, you run, you can call, what is the assumption for some of these numbers? The assumption is we experience a correction, a large correction scenario like post-global financial crisis. So why was global financial crisis a correction scenario? Because if you, let's say, define a correction in a certain way, a price decline beyond some percentage of something else and so forth, and I had a definition at the time that I can share, and that's perhaps like too much information for tonight, but you have like a definition of what is a correction, and then you see that in past global financial crisis, more than 80% of the counties in the US, which is like around 3,000 counties, right? So more than 80% of the counties actually corrected. And so if you have like a big correction scenario like the global financial crisis, then, and assuming there are different conditions. Now one can think of interest rates as one condition that is different, right? And so forth. Then like these metrics, they were very predictive of declines after the global financial crisis. Now it was like correlation was in the 80% to the actual subsequent declines. That's not something spurious, that you're predicting in the future actually. I think it's interesting. And the reason is, well, real estate is fundamental. It's like trading utility stocks, like you're coming out of finance, right? So let's say you can know if they're overvalued, something like the stocks of PSE&G, the stock of PSE&G, right? That's not Tesla, so you don't know what it is. It's pretty simple.
So basically, what you're saying is forecast. I completely agree with you there.
Yeah.
The fundamentals is at the end of the day is a keyword. In Austin, prices are definitely looking janky. It's the numbers don't add up anymore. It's 1 + 1 = 5 now, apparently. So it's definitely. I understand where you're coming from. That makes perfect sense. Thank you.
No, it's not so bad in Austin actually, because I mean, I really think it's only bad in Idaho.
Yeah.
Boise. That's actually my honest opinion. Numbers are a little high. In some of those other Western markets, like you mentioned, like 5 states besides Idaho. So it's really like the 5, so the kind of, well, Washington State, Nevada, Utah, Colorado, and Arizona. So kind of, and then you have like Texas and Florida to some extent, but it's all not so bad. But it's very recent too, because we already had the US real estate was fairly valuable, so it's quite interesting. So it's it's just like, am I comfortable? It's just kind of risk tolerance and risk decision as to what one wants to do in terms of investing or not in those markets. So and also another thing I want to say is, like, if something is overvalued, like all these numbers, so they're derived as predictors of downside risk. They don't make me neither bullish or bearish on appreciation. So if you have something like Idaho, and Idaho is, let's say, 51% overvalued, am I bullish or bearish on appreciation by virtue of this number? I'm nothing. I'm neither of the two. It has nothing to do with it. And perhaps when I was running my appreciation forecasts now before some of the recent like kind of mortgage rate spikes and so forth, Boise in Idaho was looking on 1 year ahead appreciation, was having the highest appreciation forecast. But simultaneously, it's also the most overvalued one. It has the highest downside risk too. So it's just kind of balancing out. It's just like risk reward thing. It becomes. So would I invest in Florida if valuations are, let's say, around 20%, some not very overvalued, but somewhat overvalued, so I could, because Florida has huge momentum. You would likely capture enormous appreciation over a very short time while we're in the same market cycle. And then when the market cycle ends, if it, assuming it does at some point, then perhaps you could carry some downside risk, but it doesn't mean also the market will correct, because there can be other scenarios. You can have the valuation resolves via, let's say, income super growth. Now in times of inflation, one could have expected maybe incomes are gonna also pick up or something like this and resolve some of this recent overvaluation, let's say, that was caused by same inflation, let's say. So that could be income super growth is another scenario. Or another one is, let's say, more stagnant prices, and then over the long run incomes and other fundamentals catch up, let's say. So there, it doesn't say anything as to the timing, doesn't even say if prices will correct. It's just a measure of, okay, what's your downside risk? And so just one moment, sorry, because I'm kind of jumping around. And another consideration, so like we mentioned, like some of the cities here. Right, so we mentioned like some of the cities that, well, that's the older data, that are more relatively overvalued. Another consideration is actually, well, interest rates. So if interest rates are on a 40-year downward trend, and now they picked up a little, but still, I mean, it's not like a huge change compared to like their whole historical trend. And then should one adjust this kind of market valuations? But this market valuation for the US, when computed based on personal income per capita, actually, was a fairly flat trend. It's quite interesting. And so it doesn't seem like I could adjust for interest rates, by the way. It's not so hard. It's just going to make the model a little funkier, And so if I did adjust for interest rates, then, then it just seems it's not necessary, because we've been on a humongous downward trend in nominal interest rates, but this kind of market valuations have been much more stable. So that's another consideration. Now, on the contrary, if let's say your valuation was based on something like price to rent, and again, like one should really be running kind of like regression for these things, but this is just like high level estimates. So if let's say it was based on price to rent, which is like approximate inverse cap rates, let's say, and then you have, now cap rates are correlated to interest rates, like 65%, right? Something like this historically, but they kind of deviate also often. But then let's say they're correlated. And so then perhaps you would have to adjust for interest rates if you were using that. And so that's how at the current time, I think Bloomberg Economics, they published like price to income ratio kind of based stuff, how overvalued real estate is in different countries, and they publish price to rent, and the price to rent numbers are way up, they're like higher. And that's perhaps because they need to adjust it for interest rates. And I don't know why they don't do it, but that's kind of like another consideration. Another just kind of like briefly mentioning, just like touching like all kinds of like technology topics is, let's say, blockchain tokenization is another data-driven thing. And so I don't know. So this was just a presentation where I was showing how one can create his own blockchain token. Why is it useful in real estate? Well, in real estate, that would be like a security token, and it's like the in terms of like on blockchain, you have like security, utility, non-fungible tokens. But typically, for like capital raising, it would be a security token, and then it's kind of the token is mapped to shares in a special purpose vehicle, and that's what actually real estate tokenization is. And I don't know, I just included it as a component that I wouldn't say it's data-driven, but it could foster perhaps like some liquidity and like other data-driven practices there. So those were like some different data-driven investing things. So like I mentioned, automated underwriting, off-market modeling, condition scoring, AVM, automated valuation models. Those are some tools that can give you a competitive advantage as real estate investors on the property selection side. On the market side, market valuations give you kind of fundamental analysis approach, and also like running like price forecasting, as well as blockchain can kind of expand and strengthen some of the ecosystem. And so it's kind of a new vision and mindset for real estate investing, where you're perhaps more professional and kind of like working like hedge funds or companies like this. And yeah, just, can excuse like some of the more technical slides. I had them from a presentation for my webinar. And like, these are like some of the ways to reach to me. So I have a data-driven course, my website, and also we publish market valuations data for 2,700 US counties. And you can get my investor list as well. And I have a YouTube channel. So yeah, with that, if you guys have any questions, I'm happy to, happy to respond.
Lots of info today.
Yeah, kind of jumping around a few different topics, but
I have a question.
Yeah, sure.
So I see that the data was mostly for the states. I'm just curious to know if if you are observing also the Canadian market.
Yeah. Actually,
okay.
I did it. Okay, that's like that's an interesting thing. So I did a lecture last week. So I'm kind of showing you slides from like different stuff that I did. And so this lecture was kind of on recession prospects and interest rates and things like this. And so this was okay, so let me touch on that 1 second.
And Stefan, obviously you don't have a crystal ball, but like in the next, let's say 2 to 3 years, probably we will be heading to a recession. How do you think that will affect the real estate? I mean, the data that we were able to pull in the last few years. Yeah.
Right. Yeah, that's a good question. Well, I mean, first of all, I guess your first part. So when you're saying we're heading into a recession, so that's because, let's say like the yield curve inversion that happened last month, right? So in the bond market. So let's say there was that perspective. Okay, treasury yields for the 10-year became below the treasury yield for the 2-year, and so that's like was one signal. And then another signal was consumer confidence. So consumer confidence is very, very down, and so
exactly.
Yeah, sorry.
No, I said exactly. Yeah.
Right. Yeah, exactly. So those two are kind of where it's all coming from. And then there were like I spoke to like this private equity fund that they changed their investment strategy, and they actually picked, okay, now we're going to be investing in only like secondary and tertiary markets in the Midwest, which I thought is okay. Oh, that's conservative, that's in the Midwest is fairly valued. Now, if you're in secondary and tertiary markets in the Midwest, well, you will be fine. You're not going to have much issue with this market cycle because they're not overvalued. And so, but again, like their concern was coming, very much from the yield curve. And so the yield curve is, it's why? Well, because like historically, okay, there's like I don't even know how they derived those likelihoods, but I read like some articles where it's like 2/3 probability of a recession within 12 months, right? And 98% within 24 months. Now there haven't been 50 different events so that 49 of them to be correct to derive the 98%. I'm not sure, But it's generally like very high. And here, like I have like some slides, like so that's like yield curve inversions and subsequent recessions and so forth. So that's kind of like some of the argument there. And just like just giving us a preview, and then we'll get to the real estate side. And then like another discussion. But then another consideration was, okay, if we're having inflation, then okay, that was a consideration like interest rates rising. So interest rates, they tend to like drop in a recession and kind of really plummet down in a recession. That's been the case if you look at like on this chart, like in pretty much every recession. And so now there was a consideration, okay, if we have a stagflation, so let's say we have like very high inflation, is it going to happen again? And well, the 70s seem to show that yes, okay, we have very high inflation, but again in a recession, again like interest rates kind of go down. And so those are like some of the like the broader market considerations. But then, okay, just one moment. I'm gonna get to your question in a second. And then and then there were like there's some signals like about the broader economy from tech, right? Because you guys saw like all the like small cap technology really super crashed, right? So small cap technology is crashing because of inflation and interest rates. And here's a slide on and also the central bank liquidity reversing. So like that's the bigger cap technology like Apple, Amazon, etc. It follows like the central bank liquidity. And so the trend changed, and okay, well, now everything changed for them. You know, they kind of went in a bubble before a little bit, perhaps. But then another thing about inflation is like why all those small companies, tech companies, and I'm kind of straying, you know, from real estate, but why they're like super crashing as well. Look at the 70s and like very in growth stocks, like high price earnings ratio, they call them growth stocks versus the very low price earnings ratio, you know, like utilities companies and so forth. And so the low price earnings outperforms growth stocks in times of inflation, and they do very poorly. And so that's another thing. And they also do poorly with higher interest rates. And so NASDAQ and interest rates have been kind of negatively correlated. And so that's why, like, if you guys know, like Cathy Wood, like her ARK Innovation Fund has been crashing. So those are like some of the, I guess, the signals from the broad market. Okay, interest rates, and the technology sector in the stock market, and I guess also so yield curve inversion in interest, and then also consumer confidence. So okay, so that was like some discussion. But then, and this is, by the way, in the real estate market, just 1 second, this is, by the way, the cap rate to interest rate spread. So cap rate to interest rate spread that's the latest data by National Association of Realtors in the US. And that's like how much it has compressed after in 2020 being the best one ever, actually, like besides like 2012. And so it's like super healthy for the commercial real estate sector in 2020, but suddenly now it's very compressed. And after Q1 2022, I presume like further compressing. So in apartments, like perhaps to like 1.5% maybe down will be, and so forth. And so, okay, so real estate prices, now another indicator for them is like pending sales. So pending sales have been showing some reversal in the trend. So like a reduction in like home sales. So those are like future home sales, for example. So those are like some charts from Fannie Mae and another source. So the trend has been a little negative for real estate, but again, it comes down to, in my opinion, it comes down to like what we discussed, valuations, because okay, you're going to have all those triggers, you're going to have like the higher interest rates and so forth. But if things are not overvalued in real estate, it seems historically they don't actually drop. And so this is the chart of after the global financial crisis. So the orange line, like what were the valuations of different states, and then the blue line, how much they dropped. And it's very correlated. And like in the end of the bottom of the spectrum, have all those undervalued states that, like I mentioned before, they dropped like an average of 4% only. So like when you're asking, okay, like what's the outlook for real estate? It's a good question, because so one is what's on the timing side. The only timing that is given by the bond market, where perhaps there would be some form of a recession within 2 years. Now, if there is a recession, such as 2 consecutive quarters of GDP slowdown, does it mean that real estate drops? No, because also real estate declines don't always happen in a recession. But again, assuming, let's say, it's associate this recession, which seems like an almost certainty, even for a very small recession. Let's say if it's associated with a decline in real estate, I would say it seems a little early. for US real estate, since it kind of started increasing only in 2021. And okay, and sorry, it's just super behind. And getting to Canada. So to Canada, though that would be very different. So in Canada, property markets were boosted by the cutting of interest rates by their central bank, it seems. So that's like the discussion of scans economies. So here, scans economies, like I mentioned, that if you look at Canada, Sweden, Norway, Australia, New Zealand, so they're all very overvalued. That's so in 2019 Bloomberg economics. They were already very overvalued. So Canada in price income ratio terms, around in their study, I don't know how they have done it. I'm not sure if it perfectly ties to mine, but it was 55% overvalued. In US, on the contrary, it was back then like right around 100. That's the US figure is consistent with what I have. So it kind of tells me, okay, maybe their stuff seems like relatively in line, at least with what I have. So it's kind of US was fairly valued, but Canada very overvalued. So of course in Canada, I would have a very bearish prediction in that sense, that in my personal opinion. Now, but you don't know the timing of it, because it could be that we have a small recession, let's say now. Nothing happens to real estate, it stays the same. Then it protracts a few more years. And it could be anything, it could be like 4 more years even, and then only then it crashes, who knows, right? So the timing is pretty hard to get. Now we do know again from the bond market, or do I highly expect that there is going to be some recession, some recession. It could be a small one, right? So there is some timing from that. But yeah, so that's like Canada. And this is in the first quarter of 2021, the same source, same Bloomberg economics. You can see Canada is number 2 in their study. So it's 153 in price to income ratio. New Zealand is at the top. And it's really the top ones. So you have New Zealand, Canada, Sweden, Norway, and Australia. I'm not sure Australia, they're comparatively down. But really another scans economy that is fairly overvalued. And you can see that US in price to income ratio, they had it at 95%, sounds to me a little bit low for Q1 2021, but the US real estate was indeed fairly valued in Q1 2021. I would say probably had it like 100 roughly, exactly. And so, so this is in scans economies, like again, like more recent things. So you can see like how high their real estate is. It's pretty crazy. So that's where the big bubble is in real estate at the moment, for sure. It's not in UK is less. So UK is okay, like 30%. Who knows? Maybe they came 30% or they can have a correction of 15%, and then the market just kind of moves on fine. So it's, well, I would say it's significant. 30% is big, relatively big, but it's not so huge. But really, scans economies, that's where the bubble is. And US is not. US is not. US, even though like I showed the map where there's all those Western and Southern markets, but if I for the whole US, it's at 110 at the end of year end.
Awesome. Well, thank you very much. And do you have by chance, any data showing supply demand current data on the, let's say, US or Canadian market? Because this is something that is also affecting, I guess, the value increase.
Well, I mean, it depends, because I don't know, like this kind of, I hear like this discussions on housing shortage. Now, what do you mean by housing shortage? Do you mean in terms of inventory, like on market, and sort of like lack of availability?
Yes. Yes. So correct. So what I mean specifically, if you have any data on starting houses versus the the shortage that we have on the market, because there is the population is growing constantly, and there is not enough new construction. Yeah.
I mean, I think like many of those charts that show this humongous housing shortage, they often are focused on the new housing. I feel like, and yes, I'm sure there's new construction shortage and housing is kind of getting older perhaps and so forth. But if you actually look at the most of them, if you look at, and I don't have it for Canada, again, like I don't have much anything for Canada, to be honest, but let's say in the US, in terms of again, that's not inventory on market and listings, real estate listings and things like that. I think that's a little noisy and that's a little harder to think of. But like fundamentally, you have from US Census Bureau, one has the housing supply and the population statistics for every US county, for example. And so I factor that in those valuations. So housing shortage gets reflected. Housing shortage is a very interesting one because if we think of, let me get, for example, to the cities once again, and let's say, and yeah, excuse me, let's say we have like, so here, so this is a little bit exaggerating, like how undervalued some markets are on the downside since income data is lagging. But okay, but let's say San Francisco, let's say the correct number is minus 10% for San Francisco. San Francisco is undervalued right now. It's quite interesting. So this like just to, I would go touch on housing shortage like on this. So here, like some of those percentages, they can be proxied by taking something like affordability in home price to income ratios, home price to personal income, let's say, and taking it on a historical moving average window, and then taking the difference of current prices versus that. So if affordability now is higher than it was over the past 20 years, moving average, let's say, then that market is overvalued, and that actually works as a proxy. You guys can do it yourself, like it's fairly easy way to predict, like which markets are overvalued. So a market like a big city that experiences housing shortage, like San Francisco or New York, I guess, and so forth, is interesting because let's say that their affordability cost, their price to income ratio was perhaps, let's say, at 6 in the 50s. I don't know what's the exact number. And let's say that now San Francisco is perhaps at 12 or 15. It's like really not affordable. But that market over time experienced housing shortage. So some of the difference in affordability came for very valid fundamental reasons that the population to housing supply ratio has changed. And so as you have that, but as you track changes in affordability versus this moving average of affordability that keeps shifting up, let's say, you inherently account for housing shortage in there. And that's why this kind of simple model actually works well. That's the reason why like some of those companies like Bloomberg Economics, they can include something like price income ratios, and that actually kind of works. But again, housing shortage is really reflected in something like that. And so yes, so in the US, you can go to the US Census Bureau and there is the data for housing supply and population for every county, and that's going to tell you the true fundamental housing shortage. Now, in terms of this other shortage, which is, inventory on the market, and let's say, or there's many buyers, people who want to buy a house, but there's like 100 houses that are listed right now and things like that. This is a different dynamic. I don't have the data on, honestly. It's like less fundamental. I feel it's a little noisy. You get markets in the Northeast, which are undervalued and depressed. And you get markets in the Northeast have like bids, price wars sometimes, and bids above asking. I don't know why that is, because maybe pricing is not always perfectly accurate. Maybe they underpriced it a little, and maybe that's where you're getting some of that. But I feel it's a little bit of a noisy thing. But yeah, but again, like the fundamental housing shortage, you have the data available by Census Bureau. We use this data at Realty.com, for example. And yes, so all of these numbers like I mentioned there, it's realtyquant.com. So yeah, but it's really using like governmental data.
Thank you very much, Stefan. Thank you very much. Thank you very much.
Yeah, that was awesome. I appreciate that.
Oh, sorry, I got a question.
Yeah, go ahead.
All right. Hey, Stefan, my name is Justin. Nice to meet you.
Nice meeting you too.
I just had a question. So I recently started taking this Coursera has this Google data analytics course. So like a lot of the things that you're talking about is coming together. Can you talk about other like technology, like resources that you like might think would be good for someone who's learning to like run script and like, I know, or like, and like data sources. I know a lot of cities in the US have open data sets. So I'd love to get your take on that.
Sure. Yeah, sure. That's a great question. Yeah, well, so just the data itself, like on the market side, is actually very easy. It's those sources here. I have it on the screen now. I use prices from Federal Housing Finance Agency, and again, that's for the US, not for Canada. So
I'm based in Philly, so
okay. Yeah, so that's FHFA. I mean, you can use Zero or other sources for prices, but I mean, let's say that's the governmental source. And then you have for incomes, Bureau of Economic Analysis, and for housing supply and population, it's US Census. So those are sources on the market side. Now, in terms of, because you're mentioning like the scripts, let's say, and that, so some things that like what you're perhaps like studying in some of the Google data course, well, if you start doing like some more technical stuff like machine learning and condition scoring, you would use like packages. So that's on the, if you want to process textual information, let's say natural language process, then you would use some packages like Word2Vec, Doc2Vec, NLTK, TF-IDF. There is BERT. BERT is a better one. Google came up with a newer algorithm that's proprietary called MUM.
okay.
BERT is the open source one. So BRT. So that's for if you want to, this I use it for condition scoring, but if you want to do other textual classification for other stuff and you want like this to be like technical and do it, you could use BERT, for example, or I use TF-IDF. It's less powerful than BERT. And
right now it's all it's focused on is like SQL, and then they'll go into like Python and R. So like I know that Python is very versatile, but again, you're dealing with lots of data sets, and the whole idea is looking at patterns and trying to create like an algorithm or like some sort of understanding of the data. So
yeah, in SQL, like SQL is I mean, I used to use a lot of SQL like at work when I was in finance working before. It's useful. I mean, yeah, it's good. But yeah, that's not so much the modeling. Like you said, it's more just, okay, let's kind of the data extraction. And, you know, it's just kind of, yeah, if you want to have the data in a...
So the modeling is really more the Python side of things.
Yeah, I mean,
gotcha.
Yeah,
okay.
Sure, yeah. Yeah, because they have there the machine learning and all that stuff. So those are some, and again, like the other on the images side, that's even I haven't done it, but again, like, because I was mentioning some vendors that people can use, since that's kind of easier. You can just kind of call Foxy AI, and you can call their founder, you know, or somebody there, and just like get like some kind of data one for you that works for your needs. That they're going to do the work for you essentially. But otherwise, if you want to do it yourself, it's like packages like OpenCV, SimpleCV, PO. So those are some of the stuff if you want to doing, again, to your question, because you're going to like machine learning and things like that. And otherwise, it's just let's say when doing this commercial multifamily modeling, I'm not sure if I can, okay. So commercial, that's just like web scraping. There's some web scraping that is necessary with the Selenium. So you can look up Selenium as a package in Python. Automated valuation models, they are based. So again, automated valuation model, that's things like Zero's estimate. Build a simple one yourself. So here is on this slide is a very simple version. It's actually quite interesting how simple it is. And so it's so this one is just it's a gradient boosting regression, which is a machine learning kind of regression. It's just like better regression than the usual linear regression. And so that one you can do in Python via I think it's okay. It's in scikit-learn, SK-learn package, and those are like some sources essentially.
Okay. A lot of this stuff is well above my head, but I appreciate it because all these things are like going to sit in my head and percolate for a little bit, and then.
No, I mean it takes time. You know, it takes time to kind of like get all the pieces right. Yeah. But overall, I would say market analysis is very easy because there isn't that much to do there. It's just like linear stuff, in my opinion, and it's probably 2% of my time goes on like numbers like these. But then the property side is very hard because you have data that is fragmented, that maybe needs cleaning. That how do you model those different properties? So it's, you know, that's how it is in real life. Like people pick markets very easy, but then how do you find the deal, right? So that's kind of the difficult part.
Yeah, I think it's like easier when you're focused on like 3 zip codes and it's like in your backyard, but when you start investing out of states, it's a little different, or out of country. Like the data is really helpful.
Yeah, I'm sorry. Then you need like more market analysis. That's true.
Thank you. That helps.
Sure.
All right, I think we got one more question before we end the night.
Hey, Stefan, just one more quick thing. Just need some guidance from you on how I should approach this. So currently I'm in real estate and been here for about a year and a half. And I'm currently trying to tap into the data side of what all these companies are collecting, and also from the government. Is there any tools that I can use online or I can build through Power BI or maybe Tableau that can help me to see the data the way you see it? Or if there's another option to where we can partner with you guys, if any of us on the call can partner with you, what type of services do you provide? It's a two-piece question. First, if I was to do it by myself, how would I do it? Second question is, how can we partner with you, basically?
Yeah, so if you want to, so I mean, you can do it by yourself. That's the first thing. Like I said, the market size is not hard. And so if you want to do it by yourself, you can even just do it in Excel. I mean, I'm not even so good with like all these different visualization. I mean, there are different visualization packages in Python. I'm not sure, do you want to code or you just want to, without coding, right? Just to kind of pull the data feeds and study them. Is that the better approach there, or just making sure?
Well, actually, so from your perspective, someone who hasn't, so honest to God, you're definitely throwing in some heavy hitting terms that definitely shows your depth of understanding of the market, right? So from my perspective, I only have about, like, my experience in finance is corporate finance. It's not investment banking or technical related in that sense. But I always loved data and the fundamentals of data. That's there's, at the end of the day, market is between two people. It's a transaction between two people, right? So if you look at the numbers, there's always some people that are working behind it in like actual activities. So that's how I think about fundamentals. So from my perspective, is it going after Google Analytics, or is it doing something else?
I got it. Well, honestly, I don't know. I like Excel myself. I mean, because, you know, when you work in finance, one uses a lot of Excel. So if you want to just, and it's a relatively simple way, right? And so if you want to do, you know, this study, I think before I coded it in Python, like this market side, I just first, let's try out, and I just like kind of did it in Excel, you know. And it's not that much data, so that you cannot do it in Excel, because that's for like 3,000 counties, and sure, it gets a little heavy at the 3,000 counties already, or like approximately a little less than 3,000, but it gets a little heavy at, in a spreadsheet, but not too much. You know, it's not like 50,000 or something. So yeah, definitely you can just do it in Excel. Even like some of the forecasting, like appreciation forecasting in Excel, their forecasting method that they have is actually ETS, which is fairly accurate. I mean, well, forecasting, it has all its caveats and so forth, but just as a method, it's a fairly good one. It's actually the one that's built in Excel, so you don't even need Python for that. So you can definitely do that. For any linear regression, you can use Excel as well. So I would say most of like the market analysis you can just do in just in Excel, or perhaps then, you know, you can use Tableau or other visualization things. But yeah, you can do it like that. Now the property side is harder, because there you need to code, because there's just the aspect of, you either need to connect to some vendor APIs, or, well, okay, maybe you don't need always, because if you use vendors, if you contact vendors and you contact, let's even you have condition scoring, but you contact Foxy AI, they give you a feed, they give you a CSV feed, and then everybody else gives you a CSV feed, and you have the data in this format, and then you don't need to code again. Again, you're going to do it all in Excel. But otherwise, if you're, let's say, taking some of the data yourself, like web scraping the data and so forth, then there's really no way around it on the property side, and it's like pretty much fairly coding intensive, I would say. Yeah, while the market side, like I mentioned, it's something you can do just even in Excel. But if you wanna use our data, which you know, obviously I kind of stand behind it, like that's what I use myself for my own investing. So our data, then you can just go to, so it's this third link. So it's realtyquant.com/analytics. So that's our market data. So that's market data for, like I mentioned, 2,700 US counties. And also what you get there is that you get sort of, so you buy it once, let's say, and then you get like a lifetime. I mean, I don't mean, So, but you get kind of like a lifetime update. So you get updated like all the time about it, something like this. But you can definitely do it also yourself, and then you need to keep doing it every quarter yourself too. So kind of, because you need to keep updating it because it's going to be changing, all the time, or to some extent. So, so yeah.
Okay, thank you. I appreciate that.
Yeah, sure. Yeah, sorry, I'm going to stop sharing right now.
All right, guys. Well, I appreciate everybody coming on board. If there's more questions or anything, I'll be emailing everybody, and you guys will have a copy of the recording. And Stefan, any way we can have your presentation?
Yeah, absolutely. So here I'm putting in my email address, and it's stefan@realtyquant.com. So you can just email me, and I'm going to send it to you, Matthew, as well. So yeah, absolutely.
I can attach it to the email too, also, if you want.
Yeah, perfect. That's fine.
Awesome, guys. Well, thank you so much for coming on. And if there's anything, just feel free to reach out to us. And don't forget to subscribe to our YouTube channel. Have a great day. Bye, everyone.